Hello, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown with me, your host, Dr. Michael LoPiano. Welcome. Very good to see you guys once again, despite, of course, that unappealing dip yesterday in response, supposedly in reaction to the Fed meeting yesterday and Fed Chair Jerome Powell basically iterating exactly what everybody thought he was going to say. So we're going to dig into that a little bit today in our price action recap, and before we get to our data and our technicals, thinking about what we might be looking at into the end of this week and into today's price action. So before we get started, I will of course draw your attention to the typical resources which I use, right? If you'd like to follow along with this article, it is available on Twitter. If you are watching this on YouTube, it is linked down in the description of this video. If you're, of course, watching this on X, it's right at the top of the page. I'd also like to take the opportunity here to give a shout out once again to Otherwise Category 42, at Other Category 42 on Twitter. Yesterday, I spoke about this really excellent, you might call it a due diligence. It's not quite a due diligence, right? It's not a company due diligence. Usually research gets referred to by the broader sort of retail community. Anything that kind of sounds smart or is well researched gets referred to as due diligence. It is research on some of the potential market mechanics involved in what may have driven some of our more upwardly volatile price action in GameStop over the past few years, particularly with a focus on this year and with a focus on what was occurring in 2021. Right, a number of us. I know I gave a shout out to this research published by Otherwise Category yesterday. Richard Newton, I think, did the same. It's really some great work from somebody who doesn't post super frequently. But wouldn't you know, immediately as this goes up and it gets some shout outs from prominent independent researching members of the GameStop investment community, that just like me, Otherwise Category was completely deplatformed from Reddit. Not sure why, no notice as to why. There was some notification like I received about there being some sort of a password issue, but so far no response, and of course all the content taken down. So yeah, so be careful out there with Reddit. I mean, this'll keep happening. As long if you have some sort of intention to post or to share something potentially intelligent or that furthers the community, the cultural body of knowledge on GameStop investing, watch out. You might become a target. So, just I'll link Otherwise's report again, his research again in today's video, so you can have a look. I am going to go through Otherwise's research. He does have a video of his own. I'll also link that. But I also want to make sure that I'm very interested in talking about a few points of this and sort of working this in or interpreting this in terms of maybe some of the terms that I use regularly for my own trading and investment, and sort of some of the assumptions I work with when thinking about our price action and what it might mean. So I'm going to talk about this a bit during this Friday's live stream. So it's going to happen. It starts right after market close. If you're here on YouTube, you can just join right away, and of course, I'll have a link to it on Twitter as well. So more on that topic on Friday. So yeah, so let's get into today's topic, which is to think a little bit about this retrace, as it were. Let's do this one. How we like that? Yeah, right. So retrace to the future. Got this nice. I like to see this, right? I like the Back to the Future meme here. Every time I see something happen that I see coming, maybe several days in advance, this is one of the memes that pops into my head, right? Oh, wait a second, I've seen this one before. Of course, those of you who have been watching regularly all week, you know that I have specifically pointed to what just occurred as being set up earlier this week. Monday looked like we were going to get a reversal. That reversal ended up being pretty heavy, pretty dynamic to the upside late in the trading day on Monday. And so on Tuesday, looking at that and some of our pre-market price movement activity, I said, ooh, this is looking like maybe this is setting up for a bull trap. I personally am looking at this, right? I was thinking a lot in terms of, okay, this is looking like people are setting up covered calls, short call trades, right? Of course, yesterday I talked about how just about half, perhaps at certain points, over half of our call OI was in the money yesterday. That is, you rarely see that, right? That is a rare occurrence. These stocks, right? Part of my assumption, my working assumption, is that the equities market is in a state of derivative capture. The price action on underlying derivatives is operated in order to benefit those institutions which run the options market, and that is certainly true for GameStop. Not only true for GameStop, but certainly true for, as certain can be. That is an assumption that I work within. Although, right, all knowledge is probabilistic, no knowledge is truly certain, but the validity of that knowledge is contained within its predictive power. So I work under this assumption. I've started working pretty right with my write-ups, with my price forecasts, and with my own trading. I work under this assumption, and it's been working out pretty well, I should say, with this particular endeavor. I'd love it if that were not the case, right? I mean, if that were not the case, that would mean that our markets were a lot freer and fair and not in a continued sort of parasitic state of derivative capture. But as long as this keeps working, then that to me, that's a pretty decent standard of knowledge, a decent criterion of measurement by which to assess the validity of the claim that the markets are in a state of parasitic derivative capture. So, okay. So, right, this is what we got, right? Big dip late in the day, early on, pretty tight trading range in this upper, let's say, 30, in kind of pretty tightly in this 30 to 31 range. We really didn't even get that close to, right, to 30, 30, 25, I think is as low as we got, which roughly lines up with the top sort of resistance line of what was our bearish regression channel that yesterday officially transformed, as I pointed out, into something more range bound. And we used it early on as a technical support that lined up right when we kind of got to that level of, right, it also lines up with what we saw in the pre-market here. Lines up with right when market maker gamma hedging kind of starts to kick in on the approach to that call wall. So we just start to see that have this kind of resistant or supportive effect as we move toward 30. So, right, we got that established. 1, 2, 3. Clearly, whoever launched this through the options market, this little bit of volume here, right? Launched this as kind of a 1, 2, 3 off this level using also this pre-market mark. And we moved up basically into another gamma bracket. So between 31 and 32, with steam sort of running out at around, right, 31.70. And then we got a 1, 2, 3 at the top, right? 1, 2, 3 at the bottom, 1, 2, 3 at the top. We use VWAP as an intra-trend support here to trade in this upper channel. And then as we were just kind of hanging out in the second half of this channel, set up to a big downside move here. What really drove this, right? You'll hear people, or you'll hear me sometimes talk about something like, oh, okay, this is controlled, or this is, engineered by dealers or something like that. I mean, but what really causes something like this? In the article, I outline this. There's 3 factors on an event like this that come to mind. So the first is, yes, shorting, but not all shorting is equal, right? So this looks like something that was likely initiated by the shorting of several ETFs simultaneously, or maybe not even shorting, but selling, right? Just selling. This could have been something that was likely, as I claim in the article, something that was engineered across multiple institutions, not just GME's market maker, not just GME's market maker, but across a number of institutions that plan this sort of market-wide sell-off in response to the Fed meeting, to Powell's announcement about the 25% rate cut, and this sort of idea that inflation is going to remain slightly higher for a few years. Like, Okay, right. Possibly there could be some reaction to that, but it does seem, based on what many of these remarks were in reaction to this meeting, that this was something that was anticipated, that the market was sort of pumped up a bit in order to anticipate this. Perhaps the slightest bit of news, anything except everything's great, right? Inflation's lower than we anticipated already. Nothing maybe except that was going to result. Probably not even that was going to result in something, a dip like this. So right, it starts out like that, and then institutions, maybe smaller institutions, firms, larger trading firms that know that this is going to happen, that saw the writing on the wall, something like, like me calling this out earlier. I mean, I just called this out even more vaguely. I didn't specifically say this week that, oh, this is going to happen because of the Fed meeting. That did prove as a useful bearish catalyst. But then you get something like institutions that can short large amounts of shares, kind of dumping them on the tape at key moments. So you sort of see it, like you see these little kind of hitches, or these points where we get some hang up. So we definitely got some hang up here around 30, right? So this is market maker hedging. This is people betting on a reversal from 30. And then we get, say, these volume spikes like this one here that really definitively, whoa, that really push it through these levels to force the issue. And so right all through here, we see these particular volume spikes. It does look like, from our international brokers shares available to borrow data, that it looks like about 500,000 shares were shorted yesterday that were then covered. Possibly that's what we saw late in the day and in the after hours, right? Short sale trades that were closed in the after hours, or on this slight reversal into the end of the day. Right, so not a massive amount, but it didn't necessarily need to be like that 1.3 to 1.4 million we saw initiate the shorting on Thanksgiving. There was necessarily no reason to have all of the market absolutely dump following Thanksgiving, and that's not what occurred. But that did happen on GameStop, and that took something a lot more interventive. That took about 3 times the number of shares shorted to really definitively kind of cap that bull run where it had topped out around 32. To ensure that weekly close below $30. So this time, with already that kind of background bearishness, selling, sort of market-wide, maybe shorting or sell-off planned, only about 500,000 shares needed to really kind of force the issue with GameStop. So we saw some of that. And then, right, as we saw in the options market too, if options traders see that happening, they can just jump on that, right? They can jump on that. They can buy some puts. They can sell some calls. They can exit. Maybe they'll see that as a reason to exit their long positions, long calls, which is a good idea. And the response there will be that, okay, well, you take off all this positive delta off the board, which is negative delta for market makers. Then, because traders take off their positive delta or put on negative delta for their portfolios, that means that market makers can take off hedges for those trader positions. So, a trader maybe has long calls, that's positive delta for them, that's negative delta for the market maker. So in order to remain delta neutral, the market maker goes out and buys shares to have positive delta cancel that negative delta in their portfolio. Okay, so then the trader goes out and says, oh, want to close my long calls, takes the positive delta off his books. Then the market makers go, okay, now we can take the negative delta off our books, which means we don't need these shares, the positive delta in these GameStop shares, to act as a delta neutralizing force in response to that negative delta that is no longer on our books, because the trader on the other side of this trade is done. Right. So then they can just sort of sell, well, sort of, they can go and sell shares en masse in a dip that accelerates the dip, that then allows them, right, then they don't need as much, right? So you have all these long calls, say, whose positive deltas go down with a dip, then they can continue selling their shares on that, which sends it down, right, until you kind of get to something, again, on the inverse. It's like kind of like an inverse gamma squeeze, where until you get to something like a hedging dead zone. So yesterday, yeah, it was around $28, $28.50, just shy of $28 is where we pulled up, and as we can see today, right. So if we go down to our gamma data, gamma exposure, right, 2850 and below, neutral zone. We kind of got into that. I'll talk about this in a bit. We had something of we have and had something of a put wall kind of position at 28. So we stopped right in the middle here and then maybe kind of bounced back up, since market makers were not as clearly dumping long shares as we move down this, say they do or they did in this densely positive gamma environment. Okay, so that's what we saw yesterday. Certainly, if you had short call trades, if you had covered call trades, that, congrats to anybody who had those out, something like that. If you had long puts, it didn't really look like anybody had long puts. I don't like to trade long puts. They're tough too. Like, again, right? So long puts are betting on a down move the way you would bet on an up move with a call. So it's still not structured in your favor if you're the long party, right? It's not structured in your favor. You have time, you have implied volatility working against you, which is even tougher for puts, because typically, like with GameStop especially, implied volatility is going to go down as the price goes down and goes up as the price goes up. So on a put, right, the put is going to appreciate in value the way a call will with respect to IV when the price goes up. But that's not going to help the intrinsic value of the put or help the put's delta in terms of the Vanna effect, right? So the change in delta with respect to implied volatility. Plus, you have to worry about theta. You have to worry about delta loss via charm on a put too. So none of that works in your favor while you are holding a put long, in the same way that it doesn't work in your favor while you are holding a call long. Now, especially when you're in an uptrend, when you're in a big bull trend like we are with GameStop right now, holding a put is even worse, right? Because the stock in general over sort of a multiple week time frame is moving up. So you're extra disadvantaged if you're trying to hold a long put there. So I don't even remember the last time I traded a long put, to tell you the truth. It's been I definitely don't trade long puts on GME. Not financial advice, not trading advice, but just saying that's how I am. That's why, like, I would say the only thing worse probably in this, in GME's trading environment, the only worse instrument to trade with than, say, a long call is a long put. That's what I would say. That's my opinion anyway. I don't know, you more advanced traders out there who are probably not watching this because you already know how to trade. I don't know, maybe you like what I had to say. Maybe you like my sterling sense of humor. Maybe you have some more advanced ways of dealing with that. But definitely me, single leg long puts, no way, sir. No way. Not for me. Yeah, so looking at our technical scenario, okay, even though we got this massive bearish candle, this massive red candle, still within our technical range, right? Still within our bullish regression paradigm. As I said yesterday, measured moves up, measured moves down. This was a measured move down. We're still in here. That nothing is saying cataclysm, chaos. We're going to be all over the place. Not seeing that. Not seeing that yet, not seeing that to the bullish side, not seeing that to the bearish side. I don't see those type of catalysts. What we saw yesterday was an intra-trend catalyst, something that signaled a reversal, but one that, not something that broke paradigm and caused pandemonium or anything like that. It was measured. What I've drawn here for this chart, right, because I'm starting to think about, like, okay, like we do have some technical levels that within the next month or 2 months, they're going to start converging. So our bullish channel, it's been moving pretty parallel to the 204-hour SMA, which is our deep, it's a pretty deep support. It's our deepest support. We have not tested it, right? We tested early when our trend was pretty constrained, right? We were on top of the 24-hour SMA, the 54-hour SMA, then we went down to the 100, and that kind of stopped that sort of served as something of a frame for our sort of trading within this lower channel of the bullish regression channel. So as you can see, every time the stock dipped below the 100 SMA, while the 100 SMA was in this channel, within basically a day, it traded back up. So not even a whole day, right? It basically like, okay, so if we look here, right, didn't move below it back. This is, I think, like December 3rd. Didn't trade below it. Then after hours, we dipped below it. We opened down and traded down, but then we shot up back above it and then stayed above it in the after hours and then moved down again in the later part of the day. Actually, we opened above it, traded down, then shot back up above it, right? So this marker here serves as something of an intra-paradigmatic upward reversal signal, something like that. We don't have too much clearly going for us here in RS with RSI, but basically when the price moves below this, or at least for the past few weeks, whenever the price has moved below the 100 4-hour simple moving average, basically if it happens intraday, we move back up above it intraday in sort of the next 4-hour frame, or even within the same 4-hour frame. If it happens close to the end of the day, or say in the overnight period, we pretty quickly shoot up back over it by open, basically within the opening trading hours of the next day. So look, you can go look at this, right? The 104-hour investment, that's happened every single time here we've dipped below it, and that happened earlier this week, right? On Friday, right? Friday of last week, we dipped below it. And then we spent basically only an after hours and pre-market period, as well as just maybe a few minutes below it with respect to Tuesday's trading. And then, we shot up pretty dynamically. Hey, we just dipped below it again here, just a little bit. So, I mean, what does that tell us? We might trade down here. We might trade down to this kind of resistance, but, maybe we just go right ahead, trade up here, get a little reversal, draws in maybe some more call buyers, a little more call souffle up here, and then we make sure we finish below 30, just to because dealers want that, something like that. What I drew out here was just like something of a pattern of, hey, here's what something might look like, right? Here's what it might look like for us to stay within this overall paradigm, but close in such a way that it would give dealers the longest period of time of weekly closes below $30. And it's really until about mid-January, so around, say, January 13th, based on this kind of historic $34 resistance level, that type of move, that sort of this pattern that we've seen play out for the past, say, about 3 weeks, that could reasonably be sustained without forcing too much of a transformation of the bullish regression channel, which could happen, right? A number of things could happen. But, just to give an idea about, like, hey, this is something that could play out like this. And this is something that could reasonably play out, stick within the paradigm, not cause too much instability and confidence in the overall trend, so that call buyers who like it whenever they see uptrends but don't have sort of a mind toward thinking about this context will get overly enthusiastic about buying calls, only to have a little rug pull and another close below 30. So 90% of the options contracts, 90% of calls finish out of money. Right? They could absolutely engineer something like that. That's not ridiculous. And in many cases, the dealers themselves they might not even have to do that, because there are enough institutions maybe out there that also benefit from copying dealer strategies that they can be interventionary independently, just by the fact that they have the power to do that and their interests align with dealer interests. So not necessarily GameStop's designated market maker that's doing this, Wolverine Trading. Maybe it is, right? They have an investment arm with Wolverine Asset Management, but could be some other institutions that are smaller, not functioning in the designated market maker role, but that copy designated market maker strategies in order to also benefit from copying their profitability. So something like that. Yeah, I mean, eventually, if we flatten out too much, right? So I also mentioned this. if we flatten out too much within this paradigm, eventually the lower bound of our channel is going to intersect with the 204-hour moving average, and it's going to be an inflection point. It could be a signal for a pretty decent size bullish breakout, bullish reversal within our trend. Could be a double channel transgressing thing. Maybe we head up to, if it hits it at like 30 or 31, right? It could go all the way up to 35 if we don't test those upper bounds until say late January or something like that. Assuming we don't get something like a big catalyst from Roaring Kitty, or if there's announcements from the company or something like that. That's independent of that. That's sort of still contained within this system, assuming that it persists. So, I mean, by and large, I'm still watching out for a close below $30 this week. Most of our near-term options activity was a lot of profit taking. It's hard to tell, right? Because it's mixed sentiment trades, but probably short calls here up in this previous realm yesterday, trying to take advantage of that big retrace, and then a lot of profit taking with the in the money stuff, even with puts, right? So probably people betting on a reversal, but not a hugely dynamic reversal into the end of this week, and probably still something like a close below 30. Definitely some more bearishness into next week at 28.5 open next week. Not crazy. We'll have to see how that develops, but betting on those kind of things. And yep, as both Richard Newton and I predicted earlier in the week, Max Payne moves up to 26.50. Probably it'll stay there if we get some more in the money calls taken off the board and we get a little bit more put OI. We could see that bump up to 27, but it should be around there for this week. Doesn't mean we close that low. Again, just to see kind of the 28s out of the money again by a penny. I don't think that affects dealer profitability that much for this week, right? Because what do you have at 20? No, it doesn't. That's kind of the last. Finishing around 28 is kind of the last like strike above Max Payne at 26.50 that kind of matters, because yeah, there's not that much at 27.50. It's pretty evenly split between calls and puts. There's more puts at 27 than there are calls by a decent number in the short term. More at 26.50. Yeah, so I mean this is just kind of doing it as a numerical calculation based on ideally like how many contracts are there on each side. If we were to finish exactly where we were last week and not lower, right? It means if we finish exactly at 28, it means these 4,000 puts are worthless. These 4,000 calls are worthless. In fact, because I think Max, I think Chart Exchange, I think their maximum pain calculation might not be fully up to date exactly to the day. I think they might update it like midday or something like that. I can go check actually. Did it move up to 27? It almost looks like it really should move up to 27. Yeah. Oh yeah. Hey, I just refreshed it. It's 27 now. Yeah, they updated at open. So it's 27. It's 27. Yeah. We're gonna have, and next week is now 27.50. So yeah, it's gonna look like pretty close to what we saw last week. Yeah. Finishing around 28 makes sense to me. Yeah. Okay. So yeah, and I mean we can see that. Pointing this out, it's worth to point out. I think I mentioned I would talk about this too. 28, even though it doesn't look, it's pretty neutral. It doesn't look like it would serve too much as a support. We do have a lot of total gamma accumulated at this strike. That is where our 200-week moving average is. That is about where the lower bound of our bullish regression channel is. It's right there at 28. So we've got some technical support. But then we have a couple factors playing into the options data. So we have a lot of we have a pretty sizable amount of call gamma accumulated there. It's bigger than, yeah, it's bigger than 32. It's not quite as large as 31 or 29, but it's pretty big. 110,000 accumulated call gamma. But of course, right, there's a lot of put gamma here too. So we have a small net, so it looks really neutral. The thing about this though is when you have just an absolute value of puts at a particular level, so typically where you have the highest number of puts, this is something Spot Gamma points out. You have this effect which Spot Gamma refers to as a put wall. And it's where on a downtrend, because IV levels are going down. See, I mentioned this when I was talking about long puts and why I don't like to trade them, especially single leg. When you have a lot of puts, right, IV goes down when the price goes down, but you want the price to go down when you have puts. So when the price is approaching, say, a key strike where puts are, where you have a lot of puts accumulated in the market maker gamma hedging setup, where you have a lot of put gamma, IV is going to cause market makers, the IV loss on those puts actually acts as a short, very small, very like sort of brief, maybe for a few minutes. It acts as this little cushion, as a little support cushion. Market makers have to buy some hedges, right? They won't sell hedges at quite the same amount. You'll have this sort of brief kind of hang up on top of a put wall because of the IV effect, which depletes the value of the put for those who are long, right? Long traders, and it brings market makers to actually have to hedge long shares, right? To close, I guess, to buy back shorts, something like that, in response to that IV depreciation with respect to the puts. It's all over the place. I gotta work out how to say this a little bit more clearly, to make this a little bit more clearly. But Spot Gamma definitely talks about this effect. So because we have a high amount of put gamma at that strike, and because it's right sort of neutralized by this high amount of call gamma, there is some more support at that $28 position, more than would otherwise be suggested by the sort of neutral net character of that position. So we do have some support there. But otherwise, if bears kind of come out aggressive, they could kind of push this down. I don't think that'll happen. I think we're going to move back up into this range. Actually, we can check, right? We can see what we're doing. Market's open now. Oh yeah, we're on our way. We're actually on our way back up. Well, we almost went back to 30. How about that? But yeah, so as long as we stay above this level, as long as we stay above 29, we're pretty well supported in terms of market maker hedging. I would think that market makers would probably want to keep, short institutions, dealer strategy employing institutions, let's say that, will want to keep the price today, maybe in this area. Don't want to send it too far over 30, but trading in this area is nice. There's some easy day trades can be made if that's with their trading arms, right? They can mulct this for quite a bit, and they can set up some more short positions. Set up short call positions more in this range. The recovery might encourage more retail buyers to go out and get hyped or something. They even employ people to hype up unsuspecting retail buyers to kind of go out and bet on a recovery poorly with long calls, and then possibly set themselves up for another kind of retrace tomorrow once kind of charm sets in. And maybe with a little bit of shorting gets pushed back to around 28, so they, have another sort of optimum profitability close this week. So that's more or less what I'm expecting here. If there's a bullish catalyst, if something big bullish comes in, would cause some excitement and kind of push us back in here as market makers quickly gamma hedge in response to some reactive buying pressure from the options market. Bears look like they have this kind of free rein to kind of push us down here, but again, then they would probably put themselves at risk for sending a pretty heavy reversal signal by testing that deep technical support and exposing themselves, just like bears did on the 5th of December when Roaring Kitty came out with a post. So that's looming. I doubt they're gonna risk too much of that, because that could risk then a close above 30. If too late in the week they push the price down, right? Yeah, we got pretty close to closing above 30 that week. They kind of just saved themselves with some pretty decent shorting to keep the price under 30 on December 6th. So yeah, that's what I'm looking at here. Definitely go check this out. Definitely check out. Yeah, definitely check out what Otherwise has to say in his DD. Like I said, that's going to be linked below. Yeah, check out the article if you want a deeper dive into some of this data. But yeah, thanks very much as always for watching and listening. Looking forward to seeing you guys tomorrow, and looking forward to seeing you at tomorrow's live stream after market hours. It's going to be at 4 p.m. Eastern time. I'm going to spend some time reflecting on this week, looking forward at the week to come. We'll have some time for questions and comments. And yeah, we're going to take a look at some of the key portions of Otherwise categories 42, his big DD, as he calls it. So yeah, thanks very much. We'll see you next time. Take care.